All right, so today's video, I'm going to talk about, are we headed towards a recession? Is the US headed toward an inevitable collapse? Well, assuming that Congress can get their act together and increase the debt ceiling, we're not going to talk about that, but that's a definite need to do to avoid a pending recession, largely because it would impact our standing in the global economy and have major ramifications on all of our US held debt. But we're not, like I said, we're not going to talk about that. We're going to talk about all the other factors that are going on that are impacting whether or not we're heading into a recession. I mean, I don't know about you, but I feel like every time I read something, it's like the latest prognosticator is saying 6 months to a recession. And like we've been going through that now for, the last year or two, it feels like in some cases. So yeah, what's going to happen? What's going to drive it? What are my thoughts? Let's dive in. Okay, so the first thing to understand is that the Fed has increased rates drastically, the fastest they've ever increased rates. And what that means, the reason they've done that is because inflation is at all-time highs, right? And the Fed has had to come back and say, hey, look, our job is to communicate to people that we fight inflation first and foremost. Yeah, we'll be there to help when the economy is struggling to the best we can, the best of our abilities. And now that inflation is really high, they continue to raise rates. What does that mean? So the Fed, when they raise rates, they are raising those rates on what banks can borrow from them. And so if those rates go higher than what banks can borrow, that is their cost, right? And so they have to increase their rates because they make money on the difference between what they're borrowing from the Fed in many cases and what they're borrowing from me and you when we put in our deposits and what they lend out at. And as the cost of that capital, right, those borrowing costs go up, banks have to then increase their rates that they charge you and me accordingly. And what that does is, all of a sudden, as the rates increase, that reduces the amount of demand from consumers and from businesses to borrow money. And then those businesses and consumers have less money to spend on things, and that tightens up the money supply and what's going. And so what does that mean? That means that, in general, if it costs me more to buy a house or to buy a car or to buy things on credit, I'm going to buy less of those things. Even if it's just a simple fact that it's going to cost me more, that means that I'll have less money to spend on those things, right? And you're seeing that kind of across the board, like interest rates on mortgages and car loans and credit cards and all these things, they're also going up. And it's kind of like pretty damaging and pretty frustrating because you're seeing your expenses go up and your ability to borrow money basically go down because the cost of that is going up. And what does that mean? That means that people are going to spend less. When people spend less, that means that there's less revenues, less profits, less money to pay people, to hire people, et cetera, et cetera. And so companies are laying off people. They're paying people a little bit less. You're kind of seeing that across the board occur right now. That then in turn has a huge impact on a variety of different assets. So let's talk about real estate, for example. Real estate, is in a tough spot right now because all of these people got in at record low interest rates, right? For example, my interest rate is hovering around 2%. That is crazy. If you think about it, if somebody is paying like 2% interest on their home, but inflation is going up by like 6, 7, 8, 9, 10% every year, right? It's like as long as your income is more or less keeping up with that, or your investments are keeping up with that, the bank is effectively losing money on you because you're taking those inflated dollars and you're using them to pay off these loans, right? It's like you're making money. If inflation's going up and like your income and investments and so forth are going up, let's say by like 6%, but you're only paying 2% on your interest, you're effectively like almost making 4% on your mortgage, right? And so you've got like all these things happening in real estate. Well, what that means is I have zero incentive or desire to sell my house in this market, right? Even if I could make a decent return on investment on my house, I'd have to go buy another house. And all of the houses have gone up in value by so much, except for now I've got this high interest rate, which means my monthly payment is a lot higher than it used to be. for basically buying the same house. So I've got very little incentive to buy a house, which is why you're seeing real estate prices start to come down. So real estate, tough spot. Nobody wants to sell. Inventory in the market's really low, right? And people are starting to really have to discount their houses by quite a bit because people don't think about like total value of the house at the end of the day. They really think about what their monthly payment is going to be and how much house they can buy for that monthly payment. And as rates go up, right, prices have to come down to bring that monthly payment into something that people are willing to pay. Another example is that like banks are in a tough spot. So First Republic Bank was just acquired by JP Morgan recently. Silicon Valley Bank, was taken over by the FDIC. Signature Bank. A bunch of these other banks are like really struggling. Regional banks are, stock prices are down at all-time lows. And what's happening there is that these banks, they lent out a bunch of money at really low rates, right? You think about like my example with the mortgage earlier, right? If the bank lent out a loan at 2%, but now they have to pay out like 3 or 4% interest on deposits, for example, or other investments, what happens is you have this imbalance, right? Where basically these banks are losing a ton of money on these mortgages and car loans and other, bonds and so forth that they've held. And they would look at it and say, well, look, if we hold this loan to maturity, it's going to be fine. I think it's going to be profitable, right? Because we'll get paid the 2% interest over 30 years. But the problem is it's 30 years. That's a long time to hold that loan. And a lot of banks, they don't hold loans for that long. They go and sell them to other investors. But those other investors, they're demanding not 2%, they're demanding like 4, 5, 6% interest on those loans. And so what the bank has to do is they have to basically take a loss on the loan and lower the loan amount enough so that the investor who buys it from them is able to generate an effective 5 to 6% return. And so that becomes really damaging. What's also makes it worse is like a lot of these loans historically don't last for more than 3 or 4 years, right? Most people they move every 3 or 4 years. And so these loans, they don't sit outstanding for very long. But as fewer and fewer people are looking to sell, they're sitting in their houses even longer. And so those compound to create a lot of pressure on banks, particularly regional banks that don't have kind of the ability to absorb big losses and that weren't, adjusting for their risk early enough on. And that's why you've seen the collapse of banks like First Republic and Silicon Valley Bank, because a lot of their depositors saw this and said, hey, you're losing a ton of money. There's some risk that the bank might collapse. I'm going to go pull my money out. And in the case of SVB and First Republic Bank, the depositor base was like startups in one case that had tons of money. So, they pull out like $10 million. That's a huge hit to the bank. And then First Republic, who had very wealthy clients, again, they had $10 million in the bank. They pulled that out. That hurts a lot. Versus like Chase Bank or Bank of America that have lots of really small deposits, right? And so they've gotten hammered, but then everybody else is kind of looking at all these other banks and saying, hey, you've got a ton of unrealized losses on your balance sheet. That's going to be impactful, right? If we have too many of those regional banks collapse, that could send shockwaves throughout the economy. I mean, you'd basically have like massive losses of assets, money essentially evaporating overnight. Like that would have like a massive impact on our economy. And so the Fed is watching it very carefully. That's why they stepped in and supported Silicon Valley Bank. They supported First Republic Bank. They really don't want this to spread as a contagion, but it's something that could send us into a recession for sure. The other thing is, in the world of venture capital specifically, a lot of the smartest people I know are saying that they anticipate that the second half of this year, so yeah, in 6 months or less, that it will be a prime buying and investment opportunity in private markets. And the reason for that is you have to understand how venture capital works a little bit. You have two big drivers. One is companies that are really, really strong companies have been able to raise what we call bridge notes from investors. Now, this would be like, instead of going out and saying, hey, we know in this current environment, all of the other companies that are like us that are publicly traded are trading at down 50, 60, 70%. we don't really want to go out and raise money at that valuation. And so what we'll do is we'll get our venture investors that are already invested in the company to give us a little bit more money so that we can just ride this out, and then hopefully, the market recovers and we can raise money at least a flat, if not an up round valuation. Well, all of these VCs are willing to do that. And the reason they're willing to do that is because they don't want to take a hit on their books, right? As a VC, I am marking my investments to the valuation that I last invested at or that the company raised at. And so if the company goes and they raise and it's at a massive decrease in valuation, then I've got to reflect that back on my books. And my investors are going to look at that and say, hey, you're losing money as a VC. I'm not going to give you any more money for your next fund. Right? So VCs are highly incentivized to say, yeah, let's kick that can down the road. Let's not price it. We'll give you a bridge loan, right? And in the form of a convertible note, something like a debt investment that will convert into equity in the future, or we'll give them a safe, which is basically the same thing. Really trying to just push the conversation around what the company is actually worth as far into the future as possible. Well, here's the thing. They've been doing that for all of 2022. So let's say they raised a bunch of money at a really high valuation in 21, and then 2022 rolls around and they're like, ooh, valuations are down a lot. How about we take one of those bridge loans? And that kicked the can down the road. And now we're at the end of 2023 and they've kind of extended as far as they can. They have to come back to market, and there may be a lot less appetite to do these convertible note rounds, these bridge rounds to, kick the can down the road even further. And so what I think is going to happen is you'll have a lot of really high quality companies come back to market, and that will have to raise money at, pretty aggressive terms, because all the VCs are looking at this and they're saying, I have money, but I don't know, given how much money has been pulled out of the money supply by the Fed trying to fight inflation, how much money will be available in 2024 and 2025 and 2026. And so I need to make sure that I'm getting a really good deal now to adjust for that risk that's coming down the pipeline in the later years. And by the way, this is the exact same thing that's happening in real estate. There are all these people that are sitting in their houses, right? And they're thinking, I really don't want to buy a house at these high prices and lock in a really high rate. What I'm trying to do is I'm going to hold and I'm going to stay in my house a lot longer than I would have otherwise stayed in my house. But life just moves forward, and people eventually are going to need to move, right? Job changes, divorces, starting new families, all of those things are going to force people to start, selling their houses. And so it wouldn't surprise me if in 6 months we start to see an even greater downturn in real estate prices. And at a minimum, maybe the average price will stay pretty constant, but the distribution of prices will increase, probably on the lower side, where people that have to sell their house immediately will sell it at some pretty aggressive pricing. And so for those that have cash, there are going to be, I think, some great buying opportunities. There's a saying that there are more millionaires made in depressions than there are in boom times. And I think the reason for that is probably because all the people that made their money purely during a bubble lose all of it when the bubble collapses. But the people that invest after the bubble collapses and are able to buy assets at really low prices, they're able to ride that over the long run to the next bubble and sell and make a ton of money. And so the way I'm thinking about all of this, and this is not investment advice, but the way I'm thinking about it is, if you're sitting on cash and you're very smart about looking for really great opportunities, I think there's going to be an abundance of those opportunities in the coming 6 to 12 months for those that have an understanding, they're watching markets, and they have the cash to move quickly. Anyways, let me know what you think. Are we going to head into a recession here in 6 months, or is it still going to be the recession that's always 6 months away? Let me know down in the comments what you think, and be sure to check out my video where I talk about Mark Cuban, who claims he's never profited from any of his investments. We'll dig into the numbers and we'll see if he's actually telling the truth there.